Hey guys, what is going on? Welcome back to my Robinhood portfolio. What I would like to do now is continue the discussion about high risk, high dividend closed end funds. Those companies that have very, very good returns but have some hidden dangers associated with them. I talked a little bit about the return of capital. That is the company giving back capital that the investor has already put into the stock, into the company, back to the investor in form of dividend. So it looks like it has a great dividend, the stock does, but really it's just the company giving back your own money and reducing the value of the company, which was the other thing I talked about, net asset value. A lot of these companies will trade on the stock market for much more than the underlying securities or portfolios are worth. So there can be quite a bit of a gap there. That's called a premium, and that can be the other big danger. I put a video out about each of those different risks, both the return of capital as well as net asset value. What I'd like to talk about now is a little bit more discussion about the dividend with regards to dividend payout. So as you guys know, a lot of these companies, I have one up here, Prospect Capital, PSEC, are companies that invest in underlying securities, portfolios, high yield bonds. This particular company is an asset management company. It basically invests in debt and equity in various companies that are looking to do acquisitions, that are looking to grow and develop the company, recapitalization, these sorts of things. And in doing so, it generates a return on their investments, or basically by holding that debt and equity in those companies, they get a monthly income. And that monthly income is then dispersed back to the investor in the form of a dividend. And you can see the dividend yield on this one. It's very, very good, 10.593%. And if you look over the 1 week, 1 month, it looks like it's had a pretty good return on capital as well, up 10% 1 month, 3 months, 21.55%, 1 year, 58.91%, which is excellent. And over the last 5 years, it's been kind of up and down here. But over the last year, this has been performing very well. But the danger I want to talk about is the dividend payout ratio, which is actually more than the company's making per year. So for this particular company, last year, 2016, the dividend payout ratio was 345%. That means it gave back to the investor 345% more than it actually made in income. So as you can imagine, the return of capital is quite large for this particular company. And really, you have to go back to 2012 before this company had a payout ratio lower than 100%, meaning that the company was making more income than it was giving to the investor. Which is sustainable. If the payout ratio is greater than 100%, that's simply not sustainable, and the dividend payment would have to reduce, which is what has happened over the last 5 years as well. So from 2012, the dividend was 1.22. Now it's only 1.00 per year. This is the dividend per year. This does give a monthly dividend, and the entire 12 months would be $1 for last year. The year before that, $1.19. Year before that, $1.32. 128, and back in 2012 was 1.22. So you can see the company has been reducing its dividend, and you can see that the income it's making is also reduced as well. So last year, 345% was the payout ratio. The dividend was 1.00, and the earnings per share dropped to 0.29 per share. Back in 2012, it was 1.67. So you can see that the money this particular stock is bringing in has also dropped quite considerably. So because of that, this is a very, very risky stock. So when you guys take a look at these companies, take a look at not only the net asset value compared to what the stock is trading for, also look at the return of capital, but also look at the payout ratio. If this company or any company is paying out a dividend that is greater than 100% of its earnings, you know there's something wrong there, and that's not sustainable. They're either going to have to cut that dividend payment, or they're going to have to figure out exactly what to do with regards to generating more income, and that can lead to some risky behavior, leveraged accounts, so on and so forth. So take a look at the payout ratio. If it's greater than 100%, be a little bit alarmed and be a little bit cautious about getting into these sorts of companies. I only have a little bit of capital in this company, $300 or so. Just was kind of playing around with it here. You can see I've made some good dividends over the last 6 months or so, but for long-term holds, these are not great companies. For the short-term, intermediate holding, fine, but for long-term, very, very risky. So let me know if you guys are developing a portfolio around these particular funds. If you guys have these funds already, what do you think of them? Do you think they're risky or not? I think They're somewhat risky, but I don't know. I don't have a lot of experience with them, so let me know what you guys think about these. So with that, I'll kind of end the video. As always, if you enjoy my videos, feel free to like, share, and subscribe. Hope you guys have been learning, and until next video, we'll see you then.